Hey folks, Dan Frio here. We are talking today about bonds. Well, the unique thing about this is, if you follow me on Stock Talk, you noticed last week or 2 weeks ago we bought a nuclear position, and the reason being is President Trump kept saying, okay, we need more AI, and people were like, we need nuclear, and all these other things. So I'm like, well, why wouldn't we invest in nuclear? So we did, and I'm going to show you the results of that here shortly, because yesterday, the company we were just doing research on, we did a quick little analysis. It was up 30% yesterday. So we're going to go over that stock pick that we had. And then because I focus on these things every day, this is the bond market. If you're new to who I am, I'm actually a mortgage guy. And I follow mortgage rates every day in the bond market. So I'm like, okay, we know the Federal Reserve's going to cut rates. How can we make money off of it? So I'm like, okay, I start doing all this research and I'm like, well, just buy bonds. Because as the interest rates come down, bonds get more valuable. So that's what we're going to talk about in today's video. Not really exciting because I always thought bond investings were for old folks. So now that I'm old and I dig in, they're pretty darn good investments. So let's get over to it. So here's, folks, a little bit about me and what I do. I'm actually a mortgage loan officer. You want to find more about me, just go to the rateupdate.com. But we're here for these things right through here. It is the Rate Update stock portfolio that we're going to review. So here's that position we bought about 2 weeks ago. LO. And look at it, it's down, my bad, it's down to 23% right now. But here's what I want to show you guys. We bought this position on May 27th at $53 a share. Yesterday it went to 66. If I can pull this chart, let's see, LO. Let me see if I can just pull that up. You're going to be, it's like, you got to be kidding me. This was yesterday. So let's just go to one, we'll do a 5-day chart so we can see that. But you'll see it's up 41.5% in 5 days. Okay, so this was the move that it took place yesterday. So I wasn't forewarned of that. I'm not I didn't know this was coming, but they got a contract. I think they had a huge contract from the government, and that took that price skyrocketing. So every day I focus on bonds. So I'm thinking, okay, when is a good time to invest in bonds? Well, the best time to invest in bonds is when rates are coming down. Well, everybody knows rates are going to come down, or at least we're seeing them gradually come down right now. President and the vice president are just pounding on the vice president or the federal chairman, the Federal Reserve, to cut rates. So we're in an environment where we're pretty sure that rates are going to be cut. So how do we take advantage of that? Thus, that's what created this live event. So here's what we're looking at. Best ways to invest in bonds before a rate cut. So the biggest thing here is buy long bond durations, and the reason being it has the most, it gives you the best returns when bond prices or interest rates are coming down. So it's giving us a few captions here, and we're just going to take a deep dive into these to explain how you guys can make money even in the bond market. So I'm not a financial planner, folks. I'm not a financial analyst. I don't do this for a living. I just want you to understand how to invest. So please don't trade on any of my information. This is for educational and entertainment purposes only. That's my disclaimer. But I want you to understand how bonds work, because you need to understand how bonds work if you're looking in, where mortgage rates or interest rates are going to go. Plus, it might be a great opportunity to invest. So we're going to add one of these to our portfolio today with your help. So if you guys are here and you wouldn't mind contributing to my thumbs up and thumbs down. So if you can hear me and my video is good, please just give me a thumbs up. And as we go through, I'm going to ask you a thumbs up, thumbs down on what you think of these investments. And then at the end of this, based on your votes, we're going to see which one of these we're going to add into our position. So let's get over to this. Here's something I just created with AI this morning. And here's the information I said. Understanding and bond investing in a falling interest rate environment. Why have bonds been down so much recently? So I have a pretty good package of investments in bonds. And those portfolios haven't really fared well over the last couple of years. And I'm like, well, why? Well, when you see interest rates right through here, rapid increases in interest rates from the Fed and everything else causes bond prices to drop. Okay, so when you buy a bond, you're going to get the yield, but you're also going to check out what the price is doing, because you can actually make money on a bond even before the bond matures. That's what a lot of people don't understand. The longer the duration you take out, the higher the risk. So meaning the higher the losses, or the higher the gains that you're going to get. So in this environment, we're pretty darn sure the the Fed and everybody's going to be cutting rates. So how do we capitalize on that? So here's what we're going to look at. We're going to look at some of these funds that this is recommending, and here's what we're looking at. Fed's tightening or counter inflation. They're trying to do that right now, and then we're having Treasury rising Treasury supplies and deficit. That's all. So everything that they mark out here as being one of the objectives, we give it a thumbs up. So it's asking us to look at a few funds. We're going to take a look at those here in a second. But best strategies when rates are expected to drop. If interest rates are expected to decline by 0.5 to 1%, the best strategies are, and here they are, buy long duration bonds, and we're going to look at ETFs to do that. Invest in zero coupon bonds for maximum price sensibility. Use a ladder portfolio. That's tough. That gets really expensive, and so we're not really going to go over that in this report. Considered a leveraged ETF. So what this means is if the price goes up a little bit, if it's leveraged, it's going to go up a lot. Meaning, however, if it goes down a little bit, well, if you get some losses, it's going to go down quite a bit as well. So I want the least amount of risk for us, so I don't want any leveraged positions. And then municipal bonds are good for if you're in a higher tax bracket for the state that you live in. You might buy municipal bonds in your state, so they're tax kind of exempt. So most likely we're going to look at zero coupon bonds or some ETFs that we invest in. Like you know, I love ETFs. So here's some of the ones that we're going to look at. Long-term bond ETFs performance. You can see how shitty these performances are. You have TLT, VGLT, and ZRZ. There's down. This one's down per 10% in 1 year, down 12% in average in 3 years, down average 14% in 5 years. So you're probably saying, Dan, why invest now? It's the perfect time to do this. The reason why these got hammered is because the Federal Reserve skyrocketed rates in 2021 and continued to do that, basically taking rates from 0 up to 5 or 6%. So as the rates come down and as the Federal Reserve gets more and more data to cut rates, the rates are going to come down. This is going to amplify these and make those go up. So your returns, as long as the interest rates in the economy start to drop, which I follow on a daily basis, you'll make some money. So let's analyze some of these stock picks that it had. So let's go over to the stock market. Here's what we're seeing right through here. Here's the bond market. We have 10-year treasuries. We have the Bund. We have the Japanese, the UK, and the France. So these are what's going on in the bond market. But I want to show you these. Okay, so here's the ETFs that the AI system brought up for us. It's TLT, VGLT, and ZROZ. This is a zero coupon bond, and these are ETFs with bonds in them. So, okay, let's get over to these. Okay, so here, the first one I want to go over with you is TLT. This is probably the most stable one, and I think based on the criteria we have, it's pretty cheap maybe. But what we want to focus in on right through here, the performance over the past, we'll just throw it out with the bathwater because this is when interest rates are going up. If you look at just today, this fund is up 1% today. And we look at a couple of the other ones, this one is up, 1% as well. This one is up probably another 1.9% today. So we're going to go over a couple of these. So just hang tight, and we're going to focus in on these. So let's analyze these. And if you guys if you want to contribute to this, let me know what you think. So who do we got on board? I'm just going to, as you come in, I'd love to. Sound system sound off. My left earbud is outputting audio. I'm not sure. It should be stereo for you. In most cases, I've never heard that. Might just be me. I usually don't, James. I usually don't hear that it's in one audio, but I do this every day, and my mic should be set up on stereo. So let's get over to this. Here's what we want to focus in on. We want to focus in on the yield right down through here and the expenses, because the higher the expenses, it's going to cut away on your profits. Okay, so this yield on this one is 4.39 with an expense ratio of 0.15. That's pretty expensive, but we're going to analyze this. What you can do down through here, the thing I want you to do is click holdings, so you understand exactly what it's invested in. So if you scroll down through here, this one's saying it is 100% invested in U.S. government bonds. No, that's there. 99% invested in government bonds, and they're AA. Okay, so that's what that's telling us. 90% of the assets in U.S. Treasury securities that advisors believes will help the fund track the underlying performance. So again, that's what it's buying, U.S. government bonds, the AA ratings of those. Okay, so that's that fund. So we're gonna compare that to a couple of the others. So let's go to the next one we want to see. And this is VGLT. This is Vanguard Long-Term Treasury Index Fund. Go down through here. This fund, nice fees, 0.03, virtually nothing, and its yield is 4.46. So if this fund, if the market doesn't do anything, the price of this bond doesn't move, you're still going to get a 4.46 average return each year, and you're really not paying much for that fund in expenses. Compared to this one over here, you're getting a 4.39, basically the same yield, but it's taking away more and more your purchasing power right through there. So that's, we'll probably cross this one out, but let's go over to this one, the Vanguard. Let's see what its holdings are, because if it's the same holdings, then why wouldn't we go with the cheaper one? So let's go down through here and see what it's holding. Government bonds, AAA. Okay, so this one has more secured investments, a higher yield, and less fees. So far, VGLT would be my choice. Let me know if you guys would agree with me on that one. Let's go over to PIMCO's. PIMCO's zero coupon. Now, this one's going to be more vulnerable to rate changes. Okay, but let's go down through here and see if it's worth it. This one has a 4.86 yield with a 0.15 expense ratio. Again, it's pretty expensive, but let's see what it holds. Holdings, we'll go over through it. And PIMCO is holding U.S. government bonds 100%, so it's basically the same holdings, but just a different duration of bonds. So because of the expense factor, in my case, if I was looking at this, I'd most likely say, well, it's basically the same portfolio as the others, and I have much lower fees. So far, I would be picking this one right here, VGLT. I'm going to add a few here that we didn't have in the past. Let's just go through this. This is EDV. And the reason why I'm adding this is right through here. Look at this yield. You're getting a 4.93 yield and a 0.05 cost. Okay, well, let's see what this one holds to see if it's holding the same thing. It's paying me higher yields, and it has a less of fees. So we go down through here, and basically the same thing. Okay, so far, all these are basically equivalent. Let's go to the last one I looked up. And basically what I did is I told AI, give me the top 5 holdings in this that you would recommend with the most solid performances and solid backgrounds. So let's look at this one, 4.71. That's a nice yield and virtually no fees. What is its holdings? Let's go over to that. Because we're not looking at past performance. We knew the past performance was bad because the Federal Reserve was jacking up interest rates. And again, as rates go up, these assets perform worse because if they go up, if rates go up, the portfolio is worth less. So this one's all over the board. This one is 21% B, 20% A, 54% government bonds. It's all over the map. Let's see what it's, I'm not sure about that because there's more uncertainty there. Let's go through this again. 471. I'm not going to go with that one. So if you guys agree with me, I'm going to break it down to 2. I'm going to go to BLV. Has a little more diverse portfolio, good yield, low returns. Or we're going to go with the, I don't like that one. This one right through here. This one is the summary. This one is VGLT, and the reason why this one, it has a 0.03 factor with a yield at 4.4, and it's basically the holdings that it has. They're solid government bonds. So there's virtually no chance of default with this thing, so you don't have to worry about any defaults. Where the other ones, if you get something that defaults or anything like that, your yields are going to drop because you're going to lose money. So I'm rather take the secured investment, especially because I'm buying this to be secure, get a nice yield return, and also try to exponentiate my returns because we know the market and interest rates are coming down. I focus on this daily. So the best way for you to monitor this is just watch my show every morning, Closing Bell, and I go over what exactly the bond market is doing. So when you're comfortable, possibly when you think rates are peaked out and you know interest rates are going to come down, start looking into these funds because they might be a good investment for you today to park some of that money you have sitting on the sidelines that's secure, but you're going to get some great returns and you're going to hopefully have security in these as well. So let's go over to our portfolio and kind of look at what we've done so far. So we're going to add VGLT to our portfolio. So let's go back to the rate update portfolio. And what we're going to do is we're going to go in and add this. And what I want to do is every week when I come back, we're going to monitor this and see how they're doing. So let's just monitor the portfolio we have, but let's add in our, where is it, VGLT. So we're going to go in here, we're going to add symbol, we are going to add VGLT. We got that, VGLT, we got it. Add to the system. We just added that in. I got to add a position, add a lot, and that's all we really need to do. I'm going to add one share. That's what we usually do with these positions. And we're going to start dollar cost averaging some of these as soon as we get a portfolio that we like. But look, today so far that is up 1%. But that OKLO is giving back some of those returns, folks. I believe me, it was up 30% just yesterday alone. So here's the portfolio that we've been monitoring and creating and working on. Some of the things that we've added, basically since the new administration came in, was steel. This is a steel ETF, and it's a basket of steel stocks. And the reason why is President Trump wants manufacturing back in this country. So we know that's a priority. We also know that steel's a main piece of that. We have a Japanese company was trying to buy Nissan Steel. U.S. Steel came in and bought it. Trump was a big piece of that. So we knew steel is a big implementation of our economy right now. So we purchased SLX, and it's basically a basket of steel stocks. We bought that in May for 56, and it's now at 64. So we got a nice return there. The next thing we added was this one right here. It's basically a technology account. It's doing pretty good right through here. This is going to be a long-term venture because it's AI and a whole bunch of other things. We're up 5%. When did we buy into that position? On May 14th. And then the last thing we added was OKLO. We did that on May 27th. We added our position at $53.90 a share. It is now $66.89 for returns so far in a couple weeks of 24%. So didn't have insider trading on any of this, folks. I'm just trying to make common sense of these things for you. So I was sitting there and I would watch the bond market every day, and I'm like, we know the Federal Reserve is going to cut rates. It's between Trump is going to pound them until they do so, and a lot of the economic data is coming in pretty darn good as well. So when we're in an atmosphere we kind of know something's going to happen, why don't we capitalize on it? So that's what I was trying to do. Last night it dawned on me. I'm like, okay, when the OKLO ticked up and I saw that 30% gain, I'm like, okay, what am I going to talk about today? Because stocks for me right now, we got AI stocks, we have financial stocks, we have Bitcoin stocks and everything else in here. What other sector do we need some exposure into in the wise? And I was like, well, I follow the bond market every day, and we know rates are going to go down, so how do we capitalize? So that's why I started really digging in to the bond market and saying, okay, here's the best way for you to make money. Now, if you don't think the bond prices are going up and they're going to go, instead of going down, they're going to go up, you might want to do your research on that. But also use AI for a lot of these things, because I can go in here and just basically, here's the question I asked it. What would the best way to invest in bonds if we know interest rates are going to come down and the Federal Reserve is expected to cut rates by 0.5 to 1%? And that's been all over the headlines basically every day for the past couple months based on a lot of this. And it's all based on tariffs and the China trade and the big beautiful tax bill. But as those get resolved, this isn't the most likely outcome of what's going to happen for interest rates. So how do you capitalize on that? Is this portfolio that we were looking at and how we analyze the bond markets. So hopefully that makes some more sense to you guys on investing, because my whole goal here is, folks, I'm a mortgage guy, okay? I'm not here to, I'm here to help you. I'm not here to sell you anything. I'm not a financial planner. There's nothing down there below for you guys to pay for anything. I just want you to understand the financial markets as well as real estate, and that's what I do this on a weekly basis. So if you guys don't have any questions, I'll let you go and prepare for my closing bell today. But so far, even today, rates are doing pretty good because we have the MBS up 28 ticks. That means mortgage rates eased a little bit again today, but look at this bond market. Just the other day, we had this collapse, and again, as this goes down in the bond market, you're going to make money. So that's why we did today's video. So hopefully you can understand this, you can do your own research, and you can start creating your own wealth in 2025. So thanks for watching, folks. I greatly appreciate it. Again, even though I'm not a financial advisor, I'm here to help you in any way, try to understand the economics of just wealth creating. And that's why I talk about real estate, stocks, bonds, and crypto on a daily and weekly basis.